Hey folks, Tom Gentile here. Welcome to Tom's Trading Room. It is now April 1st, 2020. I want to do a recap on some of the stuff we talked about earlier this week, as those of you that are tool members are in these live sessions that we're doing. So we talked about the markets going higher. I did not believe in that rally. I actually ended up getting more short earlier in the week. I was down a little bit, but things have turned to the direction that we expected them to go. So let's talk about April. It is April 1st, so April Fools, there's no fooling the markets unless you were buying into that rally because the markets have dropped back lower. There's a couple of reasons why. Number one, coronavirus numbers just keep on climbing. That is a fact. Number two is that even President Trump is now agreeing that things are going to get tough before they get better, all right? We've now instituted a 30-day stay-at-home policy, no unnecessary traveling. This is adding to the market's angst as well. And then finally, there's some stuff you probably didn't hear, so I'm going to bring you up to date on some stuff that's not being talked about that much in the news. This one was one that bit the dust here. UTI just closed its doors. UWTI. UWTI is a triple leveraged oil ETF that was trading at $50 earlier this year, but as oil dropped 2/3 and USO dropped 2/3, UWTI dropped from $50 a share down to 15 cents. This is why I don't trade triple leveraged ETFs. I don't like leverage on top of leverage. I already trade options. I don't need any additional leverage. So what's next? Well, here's what happened when I opened up my brokerage account this morning is I got this big thing that popped up that said there's going to be a change in the way Direxion handles their ETFs. So I went to the press release, and you can see it right here, Direxion. If you Google Direxion, go to press releases, and you'll find exactly what I found. And you're going to see that as of today, look at the Brazil fund, the Russian fund, all the gold miners and junior gold miners, energy, S&P, oil and gas. These used to be 300, 3-to-1 leveraged instruments. They are now 2-to-1 leveraged instruments because even Direxion sees that this is wiping out a lot of people. So they've brought their leverage back quite a bit. All right. Let's talk about this. So on Monday, we were discussing some different ideas of the market. And we were looking at things like, for instance, this big move down that happened off of mid-February. This is DIA. We had a big move down. We've had a pullback. All right. And from there, we look like we're starting to march lower once again. Actually, if you were to look at this maybe in the form of an Elliott wave, you could see a 1, 2, 3, 4, and fifth wave potentially heading down. All right. On DIA, the high, and I'm going to round number it for you, 295. The low was 185. And the pullback, we actually did a Fibonacci pullback very, very close to 227. So where's our next move down? If we go below the 185 level, it really does look like it's going to go down to around 150, which guess what? That's 15,000 Dow, 15K. All right. So interesting stuff to know. Today was all about watching that continuation of volatility. This week, money managers are done rebalancing. So that's going to hurt the markets as well because they're not going to be buying stocks that are on sale like they were last week and early this week. And then finally, expect the pullbacks on the markets to continue back down to those 2016 levels. So we're going to take a look at that, but I also want to talk about rules-based trading with you, and we're going to focus on the short-term trading aspect because that's where the action is in the market. To be a short-term trader in this market, you have to be a volatility trader. All right? So stop being a fundamental or news trader. It's hard to jump in and jump ahead of fundamentals because who knows what the fundamentals are. In fact, earnings are coming out in the next week, and they're going to start coming out. And what earnings? That's my answer. What earnings? Companies are going to be coming out with stuff we've never even dreamed about before. And so forget that. News, it's really hard to trade the news because so many algorithms and high-speed trading is going to jump ahead of us. The second thing I don't want you to do is don't buy calls if you're bullish. Don't buy puts if you're bearish. They're 10 times more expensive than they were back in February. And you need to learn to become a volatility trader. A volatility trader, there are 3 ways to trade volatility in this environment. Let's talk about one of them right now, and that is called volatility by history. So all of you here know what this chart is. This is a candlestick chart. And as you see green candles, that means that the market closed higher than it opened. And as you see red candles, you see the market closed lower than it opened. But many of you may not know, unless you're members of our tools, you might not know what this red line is. This red line is implied volatility. It's what option traders believe is likely to happen in the future with the stock market and stocks in general. Now, I keep tabs on every single stock that has options, and we're able to actually collect, capture, and even graph volatility so we know when it's cheap down here and when it's expensive up here. We want to be buying options when it's cheap. We want to be selling options when expensive. How about if it's in the middle? Then we look to spread options. Right now, the S&P 500 ETF, SPY, the implied volatility levels on the SPY, although very high, are in the middle of where they were in February lows and where the March highs were. So the best way to take advantage of that is to spread. So we're going to look at buying low, selling high, bear put spreads, and then I want to finish off with a case study. So bear put spreads involve trading more than one option simultaneously. What that does is that lowers the cost, lowers the risk, and lowers the fluctuation of the movement, which equals lower stress. And all of us could use a little lower stress in our lives right now. All right? Here's an example. If I were to buy the 120 put, that's the higher strike put, and sell the 100 put, I'm now robbing Peter to pay Paul, help pay Paul, and now instead of a $10 position, by creating a spread, I now have reduced that position in half. That gives me lower risk, gives me I do have a capped reward. The reward's going to be the difference between strikes minus what you paid for the spread. So if you look here, 20 points between the strikes. $5 is what I paid for the spread. Take that away and you've got a 15-point maximum reward or a 3-to-1 risk to reward to risk strategy. All right? Again, what we talk about here is we always talk about these 3 steps, all right, with the coronavirus, and that is taking lower risk in your trading. Step 2, look at what goes up in a down market, including bearish opportunities. And step 3, using and exploiting that volatility that we have in the marketplace. And we do that with spreads, and we do that by hedging volatility in options. Now, before you go, let me show you an example of one such real-time case study. So what I want to do is I want to pop over, and I'm going to look at what's going on in the overall market. This is the S&P, all right? We'll get back to that in a moment. Here's our stock chart. Right now, S&P 500, low vol back in February, trading around 10. High vol, just last month, trading between 90 and 100. Right now, we're trading around 50. So the best thing to do in this case is to spread these options. And if you're bearish like I am, you want to put on what's called a bear put spread. I just explained what that is. But what we can do is we can look in the stock option tables and we can find spreads by looking at puts. Calls are on the left, puts are on the right. I'm going to expand the puts and I'm going to move them over so you can see them. All right? So what we could do is we could look at, for instance, buying a 240 put. This is an example. This is not a recommendation. Selling the 230 put, and then putting that together and creating a spread where we are long the 240s, we are short the 230s. We're doing that for a cost of not $7.50, but $2.50 or $253 for the spread itself. Now take a look at this, all right? This is where the market is right now. This is where we are on the risk graph. If the market goes against us and goes back up to all-time highs, the worst we can lose in this case is $253. If the market goes down and just comes down and tags the lows that we had just a week ago, and by the way, this is April 17th options I'm looking at, we have the ability to bring in as much as 3 times what we are risking on this trade, all right? So that's my trading opportunity. And finally, putting that into your brokerage account would be something like this. This is a put spread, and this is an example of buying and selling 20 of these, all right? That's, like I said, an example. Buy to 240, sell to 230. We're trading around 285. So if you did it for, say, 250, if you said, I'm going to put this in as a limit order for $2.50, that's going to be $250 per position. So buying 20 of these, what's that going to cost? $5,000. Okay, again, just showing you examples. If I'm filled on a trade like this, what is my exit strategy? Well, with the volatility the way it is right now, I do two things. Number one, I get out of half of it when it reaches double its value. Then I hold the rest for the big money. All right, hold the rest all the way down into my target zone. And then when we get to the if we get to the target zone, then I'll be able to determine what my reward is on the back half of those strategies. All right, guys. Hey, thanks for joining me on this edition of Tom's Trading Room, and I'll see you next time. We'll be talking about a different way to hedge volatility. Bye now.